guys, Jamie with Sell for 1% here with our broker Dave Barlow and fellow agent Mike. And we got Ryan Cochran from NFM Lending here today to talk a little bit about interest rates. It is January 25th, 2023. And what are you seeing in the market, Ryan?
Yeah, great question, Jamie. It's pretty much staying steadily at the same pace that we are seeing it, have been seeing it. They're going down. We saw a little bit of a spike of them go up about 1/8%, but they're back down now a little bit. They're going to keep doing that, but it's going to continue to follow that trend of going down, down, down. I think that it's going to follow that trend until we get to the mid fours, anywhere to the mid fours, high fours. I think personally it's going to take until about 2024 to get to that point, but we're going to steadily see it go down until then.
What are you seeing current interest rates at right now, Ryan?
Depends on the buyer situation and specific, standards with everything, but top tier credit, everything like that, we're seeing them anywhere, mid sixes, plus or minus 1/4%, depending upon where they're falling at with, the loan amount, if it's their primary residence or investment property, things like that all play and come into account when you're determining your interest rate. So, but we're seeing them anywhere, I would say, from the 6 1/4 up to a 6 3/4. Could be a little bit lower, could be a little bit higher, just depending on that buyer's specific situation.
And we've talked about this before. The interest rates that you guys quote, isn't specifically tied to what the Fed is doing. And pretty much everybody that I, read and follow and watch, they're all pretty much saying the same thing. The Fed is still going to continue to raise the Fed rate, but I think like what you just mentioned, we're going to continue to see interest rates fall, not rapidly, but kind of drift lower. Can you explain a little bit why that happens, what the disconnect is there?
Well, the basic thing that everybody needs to know is that the mortgage-backed security bonds, the buying and selling of mortgage-backed security bonds, is what determines where mortgage interest rates are going to be at. So the Federal Reserve is the index fund. Yes, it has a loose correlation, just like the 10-year Treasury has a loose correlation with it, right? But the main thing that people need to understand is that it's all based off the mortgage-backed security bonds. People buy more mortgage-backed security bonds, it's going to be better for interest rates. If people get scared of the economy, right, which is typically when, the Federal Reserve is going to raise the index rate, that's when people start to get scared. So they sell off their mortgage-backed security bonds because they don't want to keep them because they think that they're going to go up. Now we're in that point where the Federal Reserve is still kind of at this point where they're going to continue to look at it, but people aren't as scared and they're not selling off and they're still buying mortgage-backed security bonds because they know that the real estate market now is settling down and it's not going to be going anywhere. Most people understand that the real estate market, specifically in the United States, is not going to go anywhere because there are too many people wanting to buy a home and not enough inventory. And for that reason, that's why I definitely think was where the big disconnect is between the index fund and the Federal Reserve index fund and where we would see a mortgage interest rate at.
One of the things that I have noticed over the years is that there's this balance that happens between the stock market and the bond market. And so when the stock market's doing really well, you see money being pulled out of the bond market and put into the stock market because you can make a little more money with the stock market rising quickly. But when the stock market starts to stall, and people, like you mentioned, kind of get nervous about the economy, then you see the stock market start to slow, and then the bonds, mortgage-backed securities and things like that tend to grow because people are pulling money out of the stock market and looking for a more stable investment in the bond market. Have you noticed the same type of thing?
Yeah, I mean, they definitely do go kind of opposite of each other to a degree. is from what I'm getting that you're kind of explaining it at. They do tend to, and that pattern tends to stay. During COVID, it was just like kind of a free for all. And now we're finally starting today, like you've had enough experience in this where you are saying exactly how it was prior 2020. And they tend to be opposite of each other because bonds are typically safer bet to, get your money out. With the COVID happening, everybody was just super scared and they were all selling off. But that is why the Federal Reserve then put basically in it, they did put an infinite cap of how many mortgage-backed securities bonds they could buy, which is why the interest rate shot down so low during COVID period.
Right.
Now they're buying mortgage-backed security bonds like that to keep interest rates down. So it's just depending on, brokers and,
Sure.
hedge fund managers and all the other different people that are buying, mortgage-backed security bonds or bonds in general. But yeah, it's typically a safer bet. So you normally see that it will increase it when the stock market, or decrease it depending on what the stock market is doing, because it's a safer bet.
All right. Well, appreciate that insight. Thank you.
Yeah.
All right. I guess if anybody needs a loan, Ryan is always available. His contact information is here on the screen. You can call him, text him, email him. I understand, Ryan, you work 24/7, so you'll take calls at 3 o'clock in the morning.
Well, I don't know about 3 a.m., but I have 2 girls that are under 3, so it might be a good possibility. I'm up anyway.
There you
go. Go ahead and call.
Working hard, you got to support the family.
Yep.
All right. Thank you, Ryan.
Absolutely. Thanks, guys. Enjoy the rest of your day.